Okay, John Kennedy, Portage County Treasurer. I'm going to call this meeting to order, the Quarterly Investment Advisory Committee meeting. This is our annual reorganization and regular meeting, March 28th. We're calling this at order at 2:04 p.m. So I'd like to take a roll call. Tony Battlementi.
Here.
Sabrina Christian Bennett.
Here.
Elaine Stanek.
Eileen Stanek.
Aileen Stanek.
Okay.
All right. So this part of the meeting is where we are going to go ahead and take nominations for chair, vice chair, and for secretary. So I'll take a motion for a nomination for chair.
Nominate Sabrina Christian Bennett.
I will second that.
All those in favor?
Thank you.
All those in favor?
Aye.
All those say nay? Okay. Sabrina is been nominated. Okay. Moving on, nominations for vice chair. I'll take a motion for a nomination for vice chair.
Do you want to do it? Who wants to do it?
I'll do the
Okay.
vice. Tony?
Okay. I'll nominate Tony Battlementi for vice chair.
I will second that. Okay. All those in favor?
Aye. And then I'll nominate Mr. Kennedy
I will second that.
for secretary.
All right. Sabrina
John.
nominates.
John Kennedy.
Tony seconds. All those in favor, say aye. The ayes have it. Any nays? Nope. Okay, moving on to the 2024 meeting schedule and 25. I have one date in there for 2025. The proposed dates for this, I think I'd shared this a little bit earlier with everybody, but just to get it on the record. The next meeting would be June 27th at 2 p.m. here in this same space. September 26th, 2 p.m. in this same space. December 19th at 2 p.m. And then in next year, March 27th of 2025 at 2 p.m.
Okay. Do you need us to make a motion to
Yes,
accept the?
I'll take a motion to accept the schedule as submitted.
So moved.
Second?
All those in favor?
Aye.
Ayes have it. Thank you. Okay, moving on to the policy revisions. And I'll just be very transparent with everybody here. If you want to take a quick look at what we have here, the only modifications that I've made is in regards to my name, and I also on the last page have included a spot for signatures and a date to be signed off on. And so I just have new dates and whatnot.
Did you
on page-
redline this, John, or we're just going by what?
And
Oh.
you left, all the bars you left, Brad's.
Oh, that's Brad's, I'm sorry. Here's the
Sabrina
new
has
one.
Brad
I'm
too.
sorry, guys.
Both of us.
Here's the new one. Here's the new one. That's kind of important.
I'll give you that.
Yeah. I
Okay.
wanted to provide you with the old one, but I forgot to give you the new one as well.
Okay, so what?
The only thing that has changed on this new document is on page 7. So no other revisions or corrections on my part, except under statement of currency, I have new dates provided there. And I have my name as Portage County Treasurer. Yeah, that's basically the big change, is just page 7 of this. Nothing else has changed.
Do you want to, we just voted on different, Sabrina being chair.
Oh, yeah. So how about this? I will make,
You wanna just cross those out?
yep, cross those out.
And then with our new, yeah.
Oops.
In retrospect, I should have left that blank until we had gone through the process.
Okay.
Hey, that's what we're doing, reviewing.
Yes.
No biggie. Okay. Okay, is there anything else?
Eileen, am I saying it right?
Yes,
Eileen.
that's it.
Eileen,
That's okay.
Eileen, you also need to execute this too.
Well, I'll have
There's
to
a-
take that back to the office.
Okay,
yes.
very good, very
Yeah,
good.
because we'll have our
Okay.
senior vice president sign off on that.
Okay.
He has authority to enter into contracts and all that good stuff.
So John, should we have this reprinted with the correct
Yes.
titles?
How about I do that? I will reprint this out and then send out a new document, and then we can execute it later.
Yeah,
Okay,
Okay?
sounds
I
good.
think that would look good.
All right. Yeah, that'll look nicer than what we have here.
Okay.
Yep.
Yeah, and I would say, just add that, right, the body of the policy is, it's a solid policy, and there's really no need to make any other modifications other than, as John had said, having it now executed, John as the treasurer.
Right. That's the only change
Yeah.
and the date.
Mm-hmm.
Okay. So those are the policy revisions. I also shared with you the minutes from December 28th meeting.
I'll make a motion to accept the minutes as is.
Okay, I will second.
Okay. We'll take our vote. All those in favor?
Aye.
Aye.
The ayes have it.
My gosh.
All right, and now we've moved on to the second half of this meeting. Well, actually, we've already done that with the approval of the minutes. So now for Eileen to give us the portfolio update and all the good things that are happening with Portage County's portfolio.
Absolutely. Well, thank you. Always a
Good to see you.
pleasure.
Good to see you.
Yeah, good to see you, everyone. Beautiful day.
Should
Nice.
move your plant.
Oh, sorry.
There you are.
I figured my shirt would make me most noticeable. Okay, sorry about that.
That's okay. So clearly, right in the packet here, just want to kind of touch on just briefly some of the events from 2023 that, of course, sets the stage for 2024. 2023 was certainly marked by primarily, the bank failures that did occur actually 1 year ago, back in March of 2023, which resulted in 3 large banks failing, and then of course also resulted in UBS, which having to acquire Credit Suisse. Credit Suisse was a large financial services firm as well. So there was some major players, we would say, who unfortunately had fallen victim to the impact on their businesses from the higher interest rates that the Fed had pursued in 22 and into 23 to combat inflation. While we feel very comfortable that we may be out of that woods, we do recognize that during this time the Federal Reserve did enact several programs to help provide liquidity backstops and the like to just the banking industry as a whole. And many of those programs are now sunsetting. But we don't have any reason to believe that that will create any disruption in the marketplace. Of course, though, as soon as I say that, we know we had this month the New York Community Bank enter into, that's a bank out of New York, of course, and that is actually one of the banks that had acquired one of the banks that had failed, who then got into some financial problems as a result of some of their commercial real estate holdings. So one of the things that we've talked about over the years or touched on over the years is, the commercial real estate, is a highly leveraged business, and with COVID and many office buildings and the like not being fully occupied, that we felt that could prove to be a risk to the banking industry, to the financial markets. So fortunately, we've seen some fallout from that. I know with New York Community Bank, it was also driven based off of some landlord issues as it related to also apartment buildings.
It's interesting you say that, because I used to work at Ohio Savings, which is now AmTrust, which is now, I hear, Flagstar. And my credit card was through New York Community Bank.
Really?
And then it switched to Flagstar, and then I just read that Ohio Savings, well, now it's AmTrust, just got bought out by Flagstar.
Interesting, huh?
Yeah, and this is local.
Yeah.
This is Summit County based.
Mm-hmm. Yeah, because AmTrust is up there in Cleveland, yeah.
Yeah, they were headquartered in Cleveland,
Yeah.
Goldberg's.
Mm-hmm. Yeah, so, many times, conditions like this that we experience where there's disruption in industry, does result in some consolidation, where some of the players that, I don't want to say weaker players, but some players that maybe needs to be with a stronger partner, creates an opportunity where the stronger partners do come in. So, again, this is something that, on the surface, 2023, everybody thought, oh, sure, this is all resolved, but we think there's still some underlying currents out there that could pop up, isolated events. And of course, as we know, isolated events like this, they do play a role on market sentiment, investor sentiment. They play a role on how the Federal Reserve may react or not with their level of interest rates. The other factor too that is kind of a carryover from 23 into 24, of course, is the continuing geopolitical events, and particularly now with the recent, Israeli-Hamas conflict and the impact that's the spillover effect to like the Red Sea, to the shipping lanes, brings back memories of the supply chain disruptions during COVID. Because clearly if the trade routes are disrupted and the shipping has to take different routes, there's generally additional costs associated with that.
Well, what's the impact of that bridge that just got hit?
Yeah.
That's another good point.
No, that's gonna have a major impact.
Right, because
Probably all those people ordering from Temu, probably coming over on that stuff from China. I
Yeah,
mean,
probably.
seriously.
Well, from what I understand, they've already, because of all the logistics and issues they've already had to grapple with
Yeah.
supply chain, they kind of have a better plan right now to be nimble. It's still going to impact. There's millions and millions of dollars a day that
Yeah.
they're being
losing.
lost, and jobs
Right.
as well, and that has a multiplier effect in,
Right.
in those communities where those folks live.
Yeah.
Absolutely.
Exactly. Yeah, what I had heard on the radio today was, I think, the Norfolk, Virginia, port, will be the one that
will be the place
that-
where they go. Yeah.
So
Yeah.
that's what, 200 miles from the Baltimore port. So, as far as,
You got to get down there.
yeah,
Yeah.
you just have to get there.
Yep.
But, yeah, to John's point, right, these events do
Yeah,
have an impact.
and people don't even realize it.
Right. Right, and then not only, well, in this case too, not only the supply chain, but also the disruption in just the transportation going from, Maryland down south or from down south
Right.
up north along the eastern
Yeah.
seaboard.
And water is still the cheapest form of transportation.
I mean, it's one of the busiest ports on the East Coast.
Yeah,
Yeah, cause some barge went out of control and they lost control of it and it
yeah.
did.
Wow,
And
that
it-
lost power.
Yeah,
It lost power.
lost
That
power.
lost power.
And they couldn't stop it.
No.
No, it wasn't like that.
That's a whole nother problem. The grid
Mm-hmm,
are gonna be a problem, I think, in the future, the power.
because we're so reliant on,
Yeah, and how about all those
Thanks.
cars that were driving over it and, yeah,
Yeah.
that was sad.
that.
Yeah.
So, so we started out 2024 really basically with interest rates where we kind of came into 2023. And when we flip to page 4, we can see the yield curve, which shows, of course, the level of interest rates. 2021 kind of our starting point rates were all, as we know, much lower because, the Fed hadn't started to do anything from an interest rate perspective. Inflation was not viewed as a problem. We were coming out of COVID. By 2022, which is the green line, rates had moved up very considerably, not only on the short end as the Fed had moved rates up at the fastest pace in 40 years, but also longer term rates also moved up as well. And throughout 2023, they continued to move up, and we topped out on rates in October of 23. That was kind of the high point. And it was after that point when the Fed basically pivoted, as we'll show, that then rates dropped. So we ended the year coming into 2024 with a turquoise line with the yield curve much inverted because the Fed was keeping rates at the levels that they had set in 2023. So we're pretty much at that same spot here today.
Yeah.
Excuse me.
Wow.
Yeah, what John's passing around there is a weekly newsletter
Mm-hmm.
that our investment team issues. Gives a quick little blurb each week of some of the economic data points that are moving the market, as well as then a comparison of interest rates, few interest rates.
Do you want to say
year-over-year.
anything about what the Fed said this week? I'm
Excuse me,
interrupting
I
you.
got-
Yeah.
Would you
Would you like me to get some
Yeah.
water? Do you have some?
I have some, I don't know what's going on here.
Talking about interest rates.
Yeah.
I haven't
So-
even mentioned it.
That's okay. Yeah, so basically, right, the Fed did meet last week, and the message was very similar to what it was after the December meeting, and as it has been in the at the end of the January meeting, is that the guidance is that 3 rate cuts
Mhm.
are anticipated in
Mhm.
2024, and then
Yeah.
3 additional cuts in 2025.
Yeah.
So the question becomes, within 2024, well, when should we see the first rate cut? Looking back, last quarter, expectations were that we would see it perhaps in the first quarter of this year, but the inflation numbers had not moved down as much as the Fed would like, so they held steady. And so now that the inflation is not moving quite as quickly as the Fed would like, the expectations now are that the first rate cut could occur as early as perhaps June or July. So this could be a start of this change in monetary policy, this easing of monetary policy could start latter part of second quarter, early third quarter. And so therefore we would end up the year again with 3 rate cuts that would take that overnight rate down from a range of 5.25 to 5.5 down to a range of 4.5 to 4 3/4. And then of course 3 more cuts in 25 would bring us down to a little under 4%. So clearly, the Fed, when we think in terms of their mandates, congressional mandates, they're required to try to ensure full employment. We know the unemployment rate's in a pretty good spot at 3.9%. Job growth has been fairly steady. And then stable prices is the other component. So stable prices is of course inflation, and we know they have a target of 2%.
Right.
And that's really what they're looking for. When we think in terms of this relationship between interest rates, or short-term interest rates, and inflation, take the difference between the two, that gives us an indication of, is the monetary policy what we would call restrictive? Is it such that it's creating an environment that should result in the economy slowing down? Or is it creating an environment where we're in a neutral state, where things just continue? Or is it creating an environment where the economy is, has support through interest rates? And so when we look at the Fed's long-run target of 2.5% on that overnight rate, and we look at their target of the inflation of 2%, a neutral point would be if that difference, that inflation-adjusted rate was 0.50%. And so today, based on where inflation is and where the Fed is expecting inflation to move over the next 2 years, if the Fed does not do anything with that overnight rate, then their policy will become more restrictive, just organically. And we sometimes talk about how, the Fed also has another mandate, which is avoid recession. So clearly they don't want to make a policy error. They already maybe made one early on when they were a little slow to start to raise rates to address inflation. So on the backside, we believe they don't want to, they're cognizant of not making a policy error as at the point when it's necessary to start to lower rates, so that they don't, put the U.S. economy in jeopardy.
Right.
Yeah, on the inflation picture, the inflation is generally measured as a year-over-year measure. This is the level of prices last year, level of prices this year, difference between the two, what's that change? Right now, the core PCE number, which of course excludes that volatile food and energy component, is under 3%, so about 2.8%, and we know the Fed's target is 2%. On page 6, if we look at the graph on the left-hand side, what we're showing there is if we look not only at that year-over-year comparison, but we also look at the change in prices over shorter time periods. So looking at it over 6 months, what has been that trend of change in prices over 6 months, and then a shorter time period change in prices over 3 months, we can see that that blue line and the green line are pretty much right on top of the Fed's target of 2%. So clearly the expectations would be if those month-over-month changes continue just at a very low level, that will then move up to that year-over-year comparison coming down, and the trend is such that the inflation is moving down, and that is really what the Fed wants to see, and they want to see that is sustainable as well, because another policy error would be like what occurred in the 70s is inflation had come down, the Fed then lowered rates very quickly.
Right.
Inflation hadn't been wrung out of the system.
Right.
It picked back up when the Fed had to move rates back up very quickly.
Which is why they're being very cautious.
Yes, exactly. Yeah, so we know inflation comes, different sectors of the economy, as far as, consumer goods and services, experience different levels of inflation. So of course we had the goods side, had very high inflation during COVID, as there was supply chain disruptions, as well as increased demand for, tangible items. And then once that was all met, and then everyone went back out into the world, once the COVID restrictions were lifted, and we saw an uptick in the demand and the inflation related to services, particularly as it started to flow through to labor cost. And of course, we tossed in the housing component as well.
Yeah.
And that's also has been a contributor to inflation. But some of these components are, they offset each other. So while we've seen inflation had continued in the services side, again, primarily due to labor costs, we've seen downticks in the housing inflation as well as the goods inflation. And Sabrina, you're my good person on the street, one with your title company, how the housing is doing.
Yeah, it's picking up a little bit. I think it is starting to, the weather always helps.
Yeah.
Sure.
The housing market years ago used to be very cyclical, and we knew come March through September, we were swamped because once the weather, kids got out of school, that was traditionally, but the last 5 to 8 years, there's been no rhyme or reason. So, but I can tell you, it has really picked up
Oh, good.
in February going into March. I actually was just talking to
Good.
my staff on my way here saying, oh my gosh, it feels like it used to feel in
Oh.
March. Now
Mm.
things are picking up,
Mm.
but I can tell you there's lots of cash. So my
That's
lender
right.
friends are still struggling. It also impacts realtors because, hey, if you got a decent house, you just put a sign out there and it's gone. The other thing is, it makes it very hard for folks to find housing because most people will accept a cash offer with no inspections, nothing,
That's a problem.
compared to someone that's
Yeah.
pre-approved,
Yep.
ready to
Yep.
go, first-time home buyers. So there's still a debacle in the
Yeah.
system right now,
Yeah.
unfortunately, in
That's
housing.
interesting.
You know, affordable housing is still
Yeah.
quite hard to find.
Mm-hmm.
And when I say affordable housing, that also covers people who rent. Rents are
Oh.
just out of this world.
Yep.
It's bad.
Absolutely true.
Yeah.
Yeah, there's just a shortage of all of that
Mm-hmm.
roofs available to be over
You
everybody's
know,
heads.
and people don't realize the impact that housing really is the driver of the economy because you can build all the manufacturers, recruit all the manufacturers or companies to come in and, you know, start up shop here or build here. But if you don't have housing for their employees,
Yeah.
you're gonna be like Licking County right now with Intel.
Oh,
That's a huge
yeah.
problem down there.
Mhm. Yeah.
And so, yeah, we've got quite a concern right now in the housing.
Yeah, I agree with everything you just said.
Mhm.
Yeah.
So we need to get the builders going.
Mhm.
That's a tough business.
And I have a developer who's a pretty big developer, and their sales slowed down. I
Mhm.
mean, they were selling lots like boom, 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 but now it's starting picking up.
Oh, good. That's good. Well, it's interesting because you mentioned about the cash.
Yeah.
It's, you know, the cash buyers, the amount of cash that's out there in the system. And that kind of leads into when we look at what I have on page 7, which is the leading economic indicators slide. Because it's interesting, the leading economic indicators generally has been very reliable in foretelling when a recession would hit. But yet, in this environment, we had a record really of 21 months of a downward trend without a recession. And we actually just now had a very small uptick with the latest read. And so it raises the question, well, why is this not, why didn't we fall into a recession if all of the indicators indicated that we
Mhm.
should? And we think the reason is, just as Sabrina said, there's just so much cash out there.
Mhm.
Cash still with the consumer,
Cash is king.
cash with businesses, cash with governmental entities. And as we know, all of these stimulus programs, whether it's, you know, the ARPA funds, the CHIPS Act, the Infrastructure Act, all of that puts money into the economy, which allows job creation, maintaining of jobs, and keeps things going. So clearly, when we step back, it's, you know, you hate to always say, well, this time is different, but this time kind of is a little different. Because these are, you know, going through COVID, coming out of COVID
Mhm.
and such.
That's
we've just-
different.
It is different.
Yeah, we haven't had anything like that before.
No, exactly,
So
exactly.
it's unprecedented.
Absolutely.
Yeah.
So the last page, we kind of talked on this, this is kind of the Fed's, you know, guidance of where, that overnight rate, that they're communicating, they think is appropriate to the marketplace. That's the turquoise line. This is reflecting the Fed's expectations for 6 rate cuts over the next 2 years.
Mm-hmm.
Of course, we know the Fed updates their forecast, 4 times a year. So once they update it, you know, economic data can come out and it can be different, it can change the market's expectations. And so the dark blue line is the market's expectations. And that is, it's interesting, this is the market's expectations in December, after the Fed has put out this guidance of 3 rate cuts in 2024. And what we can see is the market was expecting, that the Fed would maybe do 6 rate cuts in 2024. Well, economic numbers have come in, like we said, inflation not moving down as quickly as the market would like, and so now the market's expectations are aligned with the Fed's guidance. And we're actually starting to hear a few stray Fed members say, well, maybe 3 rate cuts may be too many in
Oh, Lord.
2024, maybe one or two. So again, this is a very fluid environment, very fluid
It's
economy.
very unprecedented
Yes.
for us, I mean,
Yeah.
yeah.
So a lot of uncertainty remains,
Yeah,
I would say, overall.
yeah. And consumer confidence is still
Yes.
one of those variables that, you know, depending on how old you are, you're gonna be much more, I don't know, you're gonna feel much better about things than if you're younger. Younger people really, when they look forward, they're anxious about the economy.
Yeah.
They're anxious about a lot of things.
Mhm. But it's interesting, it hasn't stopped them from spending.
They are spending.
Change has shifted what they're spending on.
Yeah,
And
yeah.
unfortunately,
that's-
they're spending on credit cards, and that is a whole nother
That's-
debacle coming.
Yeah, yeah.
Yeah,
Yeah.
which can add to their uncertainty.
Yeah.
They're concerned looking forward, yeah, absolutely.
Yeah,
Right.
downtown kid, I'm thinking, these kids eat better than me. Look at this.
Well, non sequitur, but there was this thing that came out a few weeks ago. You guys probably saw it, the happiness
Yes, yes,
survey,
yes.
and that folks older, if you're 50 and older, you're much happier. And then the 20 to
I'm working on that.
but the 20 to 35-year-old,
Yeah,
not in a good
they're in a
place.
good spot.
Yeah, they're not so happy. Yeah,
Why is that, I wonder?
that's a big question, isn't it? Yeah, yeah.
My opinion is social media.
Yeah.
I
That's
think
one of the
it-
Their
factors.
mamas and
Highly
daddies have
contribute.
taken care of them for a long time, they haven't got reality, now they're getting bummed because
Yeah.
social media tells them everything's horrible.
Yeah,
Or gives them some fictitious view of what it's like when it's not reality.
yeah, and it's not attainable.
Mhm.
Yeah.
Right, right.
Yeah, so, I mean, and to your point, I think, right, as we have this kind of generational shift, you know, kind of taking that really long view, you know, again, those types of shifts in the demographics within countries, within the US, impact also the market environment, impact the appropriate level of interest rates.
Yeah, and you're gonna end up having a lot of first-time home buyers
Yeah,
who are in their late 30s, 40s,
right,
before they actually acquire enough capital to be able to buy a home,
right.
you know?
Mm-hmm.
That's what Aurora amazes me. You got
Yeah.
late 30s, 40s buying $500,000 houses, a lot of them.
A lot of them, that's true.
It's just, it's amazing.
Yeah,
Well, and I think the other point too is, again, back to that demographic shift, I mean, the reality is that that generation stands to perhaps really financially benefit from the assets
Mhm.
that the 50, 60, 70, 80-year-old people have accumulated.
mm-hmm.
So, you know, that with time will also have an impact
That's a good
on the
point.
economy.
Yeah,
Yeah.
that's a good point.
Just don't tell my daughter that. No, mom and dad are poor.
By the way, I'm not giving the Kennedy girls cell phones until they're in high school, and I know I'm on record
How
here,
old
aren't
are
I?
they?
10 and 11. You're gonna hold me to this.
You know, yeah, this is way off conversation. I'll stop.
Yeah. But anyway, that's the goal. Keep them off as
them
much
off.
as possible, if that's possible.
Yeah, so clearly, as you know, we take all of this in and we, you know, formulate an investment strategy and look at investing the county's dollars and the like, you know, recognizing that there is, you know, a lot of uncertainty in the world, there remains a lot of uncertainty in the markets, but yet the overriding direction, we believe, of interest rates is lower interest rates going forward, that we are continuing our approach of structuring the portfolio to lock in, ideally lock in up to 40% of the funds maturing beyond 3 years. So when we look at the maturity distribution chart on the bottom, we can see here today we're at 35% if we add up the 3 to 4 year bucket, the 4 to 5, and the 5 to 10 year bucket. So clearly, as we have maturities coming off here over the next 12 months, that provides us with the opportunity to reinvest those funds longer term, to lock in those yields that, again, we have not seen in almost 20 years, and be able to provide some stability from an income standpoint for the county. Now, the yield on the portfolio, as we are reinvesting funds, has been going up, because of course, as we showed back in 2021, interest rates were not even 1%. So that's, really just a little over 2 years ago,
Right.
that as funds were being reinvested, there were significantly lower rates versus today, as we're investing funds, it's on average 4% or better. So with time, the portfolio yield will continue to grow as these lower yielding investments mature, and then they are then reinvested at higher rates. John and I were talking about kind of, looking back, kind of where the portfolio was a year ago. I said, well, a year ago, the portfolio was yielding, it would start with a 2. So the fact that the portfolio is now yielding a 3.14% just demonstrates how, with time, that portfolio yield does grow as the funds are reinvested at in current rates, and our kind of run rate on a revenue side, income side, would be a little over $5 million on a go-forward basis. Now, we did include in here, of course, the recent purchases. There were not too many maturities over the past quarter, other than we did roll over a community bank CD, that was a CDARS, and then some securities out in that 5-year area. And again, the weighted average yield on the reinvestments was over 4%. In the next quarter, we have $7.3 million maturing that we will be reinvesting as well.
I have a question, Eileen. Do you ever advise any other counties that actually dip into their investments and don't let them roll like we do? I mean,
that's a good question. What we find with counties is that, and this is where it comes into play, where we talk about, what's the appropriate level of cash versus investment. So having that, making sure that there's the cash liquidity piece, so that we don't have to dip into the investment portfolio. So, when we look at where we were at the end of February here, there was $124 million of cash. Now, cash is invested, of course, so it's not idle cash.
Right.
At this stage, at the end of February, the cash number is a little high, only because of the real estate tax collections process. But generally, then once that cash goes out, we can then see really what's the amount of core liquidity that the county has relative to the core investment. And what we find is, general good rule of thumb is to have at least 20% of that total in cash. Of course now, in an economic downturn, then things might start to, that cash percentage might start to get a little smaller, and then at that point.
As we saw a couple years ago.
Yes, and at that point then, we would work to, okay, now we need to start to rebuild that cash component to make sure there's sufficient liquidity for the county. Yeah, so this has been a period where most folks really have been, like the county has here, have continued to grow their investment portfolio.
yeah, they normally don't utilize it because that's why you have to have a carryover every
Yes.
year. And that is to avoid, because like I said, there's certain departments or elected officials that have statutory duties or unfunded mandates, my fave, that, if they may have levies and stuff now, but if we ever got to a point that they could not pass levies, that falls on us, like the Board of DD, like JFS. They're not just gonna say, oh, we can't protect abused and neglected children, or we can't provide services to your son or daughter. We are required by law. And so, and to my knowledge, I don't know if, I've been here not since 2014 that I know of. I don't know if we've ever liquidated or just pulled from our investments, because I don't really think it's a good thing to do. Right.
But and that's where, that kind of being able to try to plan cash.
Yeah.
Cash planning. And with counties, it's very difficult because there's so many moving parts within the county. And that's where, also with, conversations like this, if you were to all of a sudden say, oh, we're going to be embarking on, this big project, we have the contracts in place, and all of a sudden we go, whoa, how are you paying for that? Is that coming out of cash, or are you going out to borrow money?
To debt.
Yes. So being attuned to anything of that nature.
With the way the interest rates are now, would you suggest cash or
We think it's appropriate to
use the cash versus
versus borrowing.
borrowing?
Well, when we think about that, I mean, that's something that someone on the debt side, a debt advisor, is better suited to answer. But from our perspective, from what we've gained in working with public entities for years, is that it's always important to have a certain level of cash, because that helps your financial position,
Our bond
particularly
rating,
your
too.
bond rating when you go out
That's
to
right.
borrow money. So it's a balance between making sure you're not pulling down your cash and then negatively impacting your bond
Your
rating,
bond
so
rating,
that when
right.
you have debt, you have to refinance or something like that. And the other factor too is, when we think about cash, it takes time to build up cash.
Yeah, it does.
Versus if we're borrowing the money, we're paying that down at a slower time period, because there's periodic repayments. So that you're not having that immediate hit.
Impact, you're
Yeah.
spreading it out.
Right. Now granted, there's the cost associated with it, which is the interest rate
It's like
cost.
slowly rip the Band-Aid off or just yank it off.
Yeah. But we're still in an environment where, I think from a borrowing standpoint, rates are still, they're still historically
Yeah.
low. Yeah, we're not in the double-digit world, I remember. But I think, one of the key points is, as we've talked here, is demonstrated on page 12, which is really, how has, what kind of income can the county know that they're going to receive on the investments they hold today?
Right.
And so what we're showing here is, based on just the securities we have, the income that the county will receive if those securities are held to maturity. So this does not assume any reinvestment, but as we can see, for 2024, we know we've already received $756,000 of interest.
Yeah.
And this is through, this is kind of more real-time data, so this is through Monday. And
That's first quarter.
yeah,
Yeah.
exactly.
Quick.
750,000.
That's, yeah,
It's big numbers,
it's not insignificant.
right? And then through the balance of the year, we'll receive an additional 3.6 million. So we know,
Yeah.
excluding the cash that's invested, just on the securities, that the county will receive over 4.3 million of interest income. And the objective is, as we're locking reinvestments in longer term, is that it benefits each year's projected income, because that, we receive that income the next year, the following year, through maturity.
Right.
So it has an additive effect.
Correct.
And then the kind of the last page here before the holdings is just showing those statistics, that year-over-year comparison. And again, we can see that certainly while the portfolio size is a bit higher, it also, of course, is at a higher yield now, and our weighted average maturity is a little bit short at this point, still at that 2.31 years. And then the last portion of the report is just the individual holdings.
Right.
Any questions?
Oh, no.
Nope. Very good.
All right, we'll take thank you.
Thank you very much.
Take a motion to accept the investment strategy update as submitted.
I will
By meter?
Make that motion to accept.
Okay.
As is.
I'll second.
Seconded by Sabrina. All in favor, say aye.
Aye.
The ayes have it. All right. Other business. This is the portion of the meeting dedicated to discussing GrowLink. Yes, and so you have in front of you the GrowLink report. And I will provide context for some of this as well, because when you look at that those numbers, and you look at the pie chart as well, it's easy to see that a good chunk is going to vehicles, to trucking industry. 73% of all the GrowLink loans have been made to those folks. And if you want detail on it, you can look on the GrowLink spreadsheet on that next page, on that first page. And so I was curious about this. And, you know, so I made a phone call to Don Herman, who's the Chief Financial Officer over at Portage Community Bank. And I asked him about it, and we talked briefly about it. And he said, John, I'm going to direct you to Eric Decker, our Chief Lending Officer.
Yeah.
And so I had a conversation with Eric, and Eric was great. Both of them are great. And Eric explained it to me in the following way. He said, John, the way to look at it is not just the investment of $250,000. There's 9 to 15 people, for example, working at the last group listed there, this Max and Russell Trucking Incorporated. He pulled that out for me, and he says, it's not on your sheet, but they got 10 to 15 employees. And those 10 to 15, some of them, many of them, live, because I asked, I said, do these guys live in Portage County, have families here, kids going to school? He couldn't give me all of that detail, but he suggested that he believed that a good chunk of them did, in fact, live in the county. And he also said that many of them would be using that vehicle. So this vehicle is providing this company with an opportunity to kind of expand, grow, sustain the business, and provide jobs as well. And so that's the broader context on this, which is something I know both of you appreciate, all of us appreciate, is what's the broader economic impact, when a loan is made to a small, mid-sized business, small business in Portage County, what's the multiplier effect? All those folks that are employed there, where they're spending their money, where they're going to school, is that money being recirculated? And so it might, so my first look at this was like, wow, we might have a problem here. A good chunk of this is going to the trucking industry. I would like to recalibrate that if possible through promotion and marketing. And I want us to be aware that that's happening. That's a data point that I think that's very important. But I can also be very convinced, as I know you guys are very economically focused as well, and what's best for Portage County and the best use of the taxpayer dollars here is if that money, in fact, that $250 is being, it's sustaining jobs and those folks are able to live here and stay here in Portage County and spend money here, I think that's what we all want. Now, is there a way, like let's say, I'm not proposing this per se, but if we we're down to $4,000, so obviously we'll need to make a decision about how much more to put back into it. My suggestion would be, but I'm opening this up for discussion, we go with $1 million into it, and I do a better job, and I work with the bank to check in on a regular basis and find out, hey, what kind of promotion, marketing are you guys doing? I can't tell them what to do, and nor should I, but I just want to stay in. I want to stay in conversation with them to find out, what is the demand? Are we meeting the demand? And are we promoting this thing enough? Another sidebar thing before I'll open it up for discussion here. So I met with John Burke, who's he's been the county treasurer down in Medina for the last 20-some years. He's been down there a long time. He has a program down there that's just residential. He doesn't do the commercial piece at all. But one of the things that he said to me was, you got to promote it, and you got to work with the bank to promote the hell out of it. And he goes, these loans just don't happen. people gotta know about it.
Well, and that's what I was gonna say, in all
Yeah.
fairness, all these trucking companies talk to one another.
Correct.
So I'm sure once one went there, then that's what it tells me. But it also says we do need a better job. And we've had the same problem with our revolving loan funds. We now have a steering committee that consists of neighborhood development services, because they oversee like the revolving loan funds, and with Portage Regional Planning, because they oversee the CDBG funds and the critical infrastructure funds, that we work and we promote them out there, and we're getting a lot more projects, because it always seems like it was the same people coming to the plate, and we're like, we gotta do better. There's other people,
Right.
they just don't know,
Yep.
that this is available.
Right, and when I talked to Eric, I said, Eric, data informs all our decisions. So he's gonna try to provide me with more metrics, more data about who's getting this. How many employees do each of these companies
Yeah.
have? And any other data that could help us make decisions about it. So I have been educated a little bit about the economic impact of this, and I think that always has to drive our decisions
Yeah.
on these types of loans.
We're focusing on trucking, but as I looked at each one of these, there's a very different from Peterbilt tractors to haulers and balers and vehicles. to
Yes.
Fleet. It's,
Yes.
yes, they are vehicles.
Yes.
And they are trucks,
Right.
but we've got like 9 different avenues of
That's right.
business that are focusing there.
Yes.
So it's not just me buying, it's everybody buying a semi. It's
Right.
you're
I
going,
don't think there's
Yeah.
anything
Yeah,
wrong.
yeah,
I
no,
just
I-
think once one does it, then the
Yeah.
word
Right.
spreads.
The word
And-
spreads, and we
yeah.
could very
And you can't
quickly,
fault them.
we
They
could very
qualify,
quickly,
so-
yep, we could very quickly go through the mill, and that's where I'm cautioning us just a little bit, like,
my thought would be is you've got trucking. So apparently they speak to each
they
other.
do.
Okay, so
Yep.
Mm-hmm.
let's pick 2 or 3 other business types, and rather than shotgun everything,
Mm-hmm.
we've got several different companies that are utilizing trucks or increasing people. Identify a couple groups. There's a couple farmers on here, and there's
Yep.
a Peterbilt
Yeah,
truck.
how do we do a better job
So
diversifying?
yeah, start with
Yeah.
picking 2 or 3 groups that would be good targeting rather than a shotgun to find out who's gonna.
I agree with
Yeah.
you.
So-
I like that.
I
like that.
You've got somebody that you've spoken to a little bit further away. What are some of the other groups that we should target?
Yeah.
And then do that versus.
And the one thing I will have to say with this program is when they go to the banks, they have to qualify
They
by
do.
the bank's requirements and restrictions.
They do their
and
due diligence, the
underwriting.
bank does, yeah.
It's not
Yep.
like anyone can come
Yep.
in there and they just
And qualify.
get it.
No.
They have to qualify at bank
Correct.
standards for
Correct.
lending.
I had a call this morning from a farmer who wants to take out a $25,000 loan.
Okay.
So we got to continue this program because we want to make sure our farmers.
don't
Yeah.
have your 25,000.
Especially the
you thought-
farmers.
We-
You're
That's
21
what-
short.
Right.
A little
So,
short.
so that's where we are with it. I think we're all in agreement that we should re-up it. And I guess the question is, do we go with the mill? And then, and here's the other thing, guys. We can make adjustments as we go. And so the next advisory board meeting we have, I can come back with more data, more metrics, and I can start saying, hey, here's, we upped it to a mill. We're getting close, or we're still off a bit.
Bring me back into reality of how much does a county, we making a little bit of money off this?
A little.
Or the bank is making
The bank makes the most
most
of it.
most
Yeah.
money?
Right.
So,
And the bank's
Yes, we do
taking
the
the
work.
credit risk.
right, so we're,
Yeah.
Right.
so if we're utilizing $1 million of the county money, we're not losing anything.
But the other benefit is that multiplier effect
Yes.
to the broader economy, which raises
Yeah,
all our
this-
boats, right?
Especially
Yes.
for example, the trucking industry. That is
Yeah.
definitely something that
Yep.
impacts the economy for us.
Right.
And so, and I remember when this first started, we had $1 million that like practically sat
Sat
there
there.
for
Yep.
several years. No one really utilized it. Then we decided to expand
Right.
the program to go into farming, agricultural,
Mhm.
and then business.
Mhm.
And this is where now we're seeing it's
Right.
actually being utilized like it should have been all along. But again, the problem was you got a good rate and stuff, but you had to meet the standards of the banks,
Correct.
and that wasn't good for a lot of
Correct.
people.
Yeah.
So I see this as a good thing
Yeah,
Mhm.
yeah,
that we're doing a good thing and providing a good service
right.
to our businesses and to our farmers who are so important.
And I do want to make sure that the homeowners who have a need as well for a septic or for some other home
Is
improvement,
still
we still have a little bit there for them.
So you have, out of these people here, you've got 9 that appear to be small households.
Yes.
And
Yes.
then you've got 10 that appear to be some type of business.
Correct.
And a couple of them I can't classify just by looking this quickly at it. But I think there's a nice variety of businesses and
Distribution.
homeowners.
Yeah, yeah.
Yeah, so
And I
I
know you
would
s-
be
go ahead.
in favor. I would be in favor of increasing it $1 million, considering right now where we're at because of the interest rates and stuff. And like I said, I don't really feel that we could go wrong with it. So I mean,
I would say, okay, to the $1 million.
Okay. I guess should we just do a motion then to,
Eileen.
yeah,
Yeah,
is that,
it's just a matter of, right to your point, do you just do a motion, or do you have to do, I don't think
We're
you have to do a
gonna
resolution.
increase it from $2
Okay.
million to
I think a
$3
motion,
million.
Yeah.
is that what we're
Yeah.
gonna do?
Yep.
From 2
Two-
mil to 3
2
mil?
million to 3 million, yes, that would be an
Okay,
additional
okay.
million. Yep.
All right. I'll entertain a motion to increase this fund
Rolling.
from 2 million to 3 million.
Second?
All
Okay.
in favor?
All in favor?
Aye.
Aye. Any opposed?
Motion carries.
Motion carries.
Yeah, because we only have 4,000 of the 2 million left, correct?
Correct.
It's
So-
not gonna make it through the year
Yeah.
if things go
No.
this way.
So,
But when do these start getting paid back or not? I mean,
when
how
are they
does?
coming, the maturity?
You get,
Yeah.
Yeah,
you get that in a while.
27.
Well, a lot of them are fixed
10
years.
10
4, I
10,
see a
5.
4.
10,
Yeah.
5, yeah, 2028.
1, 2, 3.
yeah,
1, 2, there's only
I see a
5 of
lot
them
of
over 10
short-term.
years. Everything else is 4 to 5, 4 to 3 years.
Yep.
3 to 5. 3
Yeah,
to
so that's short
5
term.
to 3
So
years. Yep.
yes.
we should start seeing some of these in the next, because these are all done in 22 and 23. So figure the shortest term I see for payback is 4 years. That'd be 27. So hopefully
Okay,
we'll see how we're doing and
okay.
we may have to adjust.
And we
it
can
again.
make adjustments as we get more data,
Yeah.
right? You know, and so we'll just keep, every time we meet, we'll review this, and I'll have the latest context from the bank as to what they're seeing on the ground as well.
And
I
one
think
thing-
that context is very important, knowing the number of employees out of place and all of that is really important data.
A
And-
little bit
For
more
us to have.
demographics on the company.
Yes,
Yeah.
yep. Any more discussion on GrowLink?
No, I
Okay.
think it's good.
All right. Well, all
If not, I'll make a motion to adjourn.
Second.
right.
All in favor?
Aye.
Opposed, same sign.
Okay.
Very good.
There you go.
You wanna hit Cassidy so she can turn on?
I know I threw a lot of paper at you guys. Thank
Sure.
you
Well,
for,
thank you.
No,
yeah.
no, it was very good. I always feel good when they come to these to hear how things are going and if there's a little light at our end of our tunnel.
You're gonna get us back the policy. that
I
says-
will